Did you know you can export goods and services from India without paying a single rupee or GST up front? I mean, it sounds almost too good to be true, right? But it's literally how the law works. Under Indian tax rules, exports are considered zero-rated. Sounds fantastic on paper, but here's the kicker. The reality is that so many exporters are still needlessly trapping their precious working capital. They're paying upfront taxes simply because they just aren't using the right strategy. So let's fix that.
Okay, let's dive into this. Picture yourself at a fork in the road. Down one path, you have the export with IGST payment route. Take this way, and you're paying tax out of pocket up front, and then you have to cross your fingers and claim a refund later. The glaring red flag here? Absolutely, yes, massive cash blockage. But down the other path, we have the export under LUT route. This is where you bypass that upfront payment entirely. Cash blockage? No way. This LUT method is basically your ultimate tool to rescue your working capital.
So, welcome to this explainer. Today, we're unpacking Export Without Tax Payment, the complete guide to LUT and GST refunds for 2026. We are going to break down exactly how this brilliant LUT strategy actually works, so you can keep your hard-earned cash flowing right where it belongs, which is, inside your business.
Here is our roadmap for today. We're covering the export tax dilemma, the LUT cash flow saver, some real-world examples, exactly how to file, claiming those refunds, and finally, common mistakes you definitely want to avoid.
All right, starting off with Section 1, the export tax dilemma.
There's this kind of fascinating paradox in export law that catches a lot of businesses totally off guard. See, the government genuinely wants to encourage international trade, so exports are designated as zero-rated. That just means the final export shouldn't carry any GST burden. Sounds simple, right? Well, you as the exporter still have to actively choose how to handle the integrated GST, or IGST. If you don't file the right paperwork, you end up paying this tax out of pocket first. You're basically acting like an interest-free loan to the government while you wait months for a refund. It's a dilemma for sure, and it requires a really smart choice.
Which brings us to Section 2, LUT, the cash flow savior.
Think of this as your VIP pass. It's the legal mechanism that lets you drive straight past that upfront tax toll booth. So the crucial point is understanding exactly what this VIP pass actually is. LUT stands for Letter of Undertaking. It's a formal declaration you submit using Form GST RFD-11. You're essentially making a promise to the government saying, hey, I'm going to export these goods or services, I'll follow all the rules, and in exchange, I am not paying the IGST on this invoice. And instead of an IGST refund, you just get to claim a refund of the input tax credit you've already paid on your everyday business expenses.
Now, this VIP pass isn't permanent. An LUT is only valid for one single financial year. Say you file it on April 10th, 2026. Well, it's only good until March 31st, 2027. You've got to renew it annually. If you accidentally make an export on April 1st of the new year without renewing, you are right back to paying taxes up front. Ouch.
Let's move on to Section 3, Real-World LUT Examples.
Concepts are great and all, but let's talk real numbers to see exactly how much working capital this actually saves. Imagine a company, let's call them SS Digital India, exporting mobile accessories. They land a really solid export order worth 5 lakh rupees. But to fulfill that order, they had to pay 90,000 rupees in GST when they bought their inventory. If they don't have an active LUT, they've got to pay an additional 90,000 rupees of IGST on the export invoice straight out of their own pocket. That is a painfully unnecessary way to trap your own money.
And this brilliantly illustrates the solution. If we break down the totals, without the LUT, their invoice balloons to 590,000 rupees because of that 18% IGST. But with the LUT, the GST is strictly nil. The invoice stays at a clean 500,000, zero upfront tax payment required. And what happens to that 90,000 rupees they paid on inventory? It just safely sits in their electronic credit ledger, totally ready to be refunded later. That's 90 grand kept entirely liquid for the business.
And hey, it works exactly the same for services. Imagine a software company exporting $10,000 worth of development services to the US. That's roughly 8.5 lakh rupees. To pull off the work, they paid GST on laptops, internet bills, software subscriptions, all totaling 23,400 rupees in input tax credit. With an LUT, they bill their US client with zero GST and then they file to get that 23,400 rupees refunded directly to their bank account.
Okay, Section 4. How to file LUT. Seeing those kinds of savings, you're probably wondering, okay, how do I actually set this up? Honestly, the bureaucratic process is surprisingly straightforward. First off, who's eligible? Pretty much every GST-registered exporter can file this, provided you haven't been prosecuted for massive tax evasion, of course. To get started, grab your basic digital paperwork, your GST registration, PAN, your import-export code if you have one, details of your authorized signatory, and your digital signature or EVC. Once you have those ready, you're set.
Here are the exact clicks you need on the 2026 GST portal. Step 1. Log in and navigate to User Services. Step 2. Click on Furnish Letter of Undertaking. Step 3. Select the upcoming financial year from the drop-down menu and fill in the required details. It's mostly just checking boxes and adding a couple of witnesses. And Step 4. Submit the whole thing using your digital signature certificate or EVC. Boom! Just like that, an acknowledgement is generated and your cash flow is locked in and protected for the next 12 months.
Moving right along to Section 5, claiming your GST refund. Now for the absolute most exciting part, getting your money back. You've exported without paying tax, but you still have the GST you paid on your everyday purchases just sitting around. Let's see how this builds into a refund pool. As you run your day-to-day operations, your purchases stack up. Say you pay $45,000 in GST for raw materials, then $15,000 on office expenses. Another $15,000 goes to packaging and freight. Every time you make a legitimate business purchase, this input tax credit accumulates, kind of like water slowly filling up a bucket.
When you tally all of that up right before making a massive 10 lakh rupee export sale, your total accumulated ITC equals 75,000 rupees. And because you smartly used your LUT to export without paying that upfront tax, this entire 75,000 rupee bucket becomes your eligible refund claim.
So how do we turn that bucket into an actual bank deposit? Step 1 is absolutely critical here. You must accurately file your GSTR1 and GSTR3B returns first. Don't skip that. Step 2, go back to the portal, navigate over to Services, then Refund, and click Application for Refund. Step 3, select your specific category, which is Refund of ITC on export without payment of tax. And Step 4, fill in your details, upload your shipping bills or service proofs, and hit Submit on Form RFD01. Once the department processes it, the money is wired straight to your bank. But hey, quick word of warning here. Do not procrastinate on this. The law gives you a very strict 2-year window from the relevant date of your export to file this refund application. If you wait too long and miss the deadline, that money is legally forfeited. Poof, gone. So please mark your calendars and file your RFD01 regularly. All right, final section, number 6, avoiding common refund mistakes.
We want this whole process to be absolutely seamless for you. So let's quickly break down the traps exporters constantly fall into. Number 1, just straight up forgetting that yearly LUT renewal in March. Number 2, simple typos causing a mismatch between the shipping bill and your tax invoice. Number 3, discrepancies between your GSTR1 and GSTR3B filings. Guys, the numbers must align perfectly. And lastly, for the service exporters out there, failing to obtain the FIRC or BRC from your bank, proving that the foreign currency actually arrived. Seriously, a single mismatch here will freeze your money in the system, so double-check everything.
To summarize our core takeaways today, let's break down the final verdict. If you're an occasional exporter, doing maybe one shipment a year, the IGST method might actually be simpler for you, since the shipping bill itself acts as your refund application. But if you are a regular, serious exporter, the LUT method using Form RFD01 is absolutely the way to go. It completely shields your working capital.
So, as we wrap up this explainer, I want to leave you with a vital question to reflect on. Is your working capital actually working for you? Or is it needlessly trapped in the GST tax portal? By taking just a few minutes to file an LUT, you can keep your cash in your business exactly where it belongs. Thanks for learning with me today, and I highly encourage you to go review your own export setup right now.